the McAlvany Weekly Commentary, covering monetary, economic, and geopolitical news events.
Here's the present tense reality. It's simple. The markets are on a tear higher. So we have, as we described earlier, we have a form of stability. And I just would remind you of Minsky at this particular moment in time. So you don't have to blindly go to the financial slaughter when instability becomes a reality of the moment. And I think that moment is not far from now.
Now here are Kevin Orrick and David McAlvany.
Welcome to the McAlvany Weekly Commentary. I'm Kevin Orrick along with David McAlvany. David, the price of prosperity and the price of calm and the price of low volatility. All you're really asking me and my kids and my wife and my parents and every other man, woman, and child in the United States is for $183 a day. That's it. For every head in the United States, every soul on this boat, $183 a day right now. Good thing that we have prosperity.
Yeah, QE4. So, we have yield curve, and that yield curve has now a positive slope once again.
I'm so glad we're back. No recession, right? That's what that means?
Yeah, because the inversion, which was occurring and which traditionally is signaled recession, and as recently as the spring of 2019, the San Francisco Fed was referencing that as a very reliable indicator of recession on the horizon.
And an inverted yield curve is simply shorter-term rates paying higher than longer-term rates. And when it inverts, it usually says there's going to be a recession. That happened this spring.
Right. So we're actually back to normal. It no longer suggests signs of a recession. And we're glad to see that you've got sort of the mechanics of the Fed intervention working effectively. Again, right. Where QE4, they're buying down the rate at the short end of the curve and eliminating those inconvenient signals. And it reinforces the market uptrend. It buttresses confidence. That's kind of how it reinforces the market uptrend. God forbid the inversion remain and investors look at that and then begin to act on sort of the suggestive recessionary period ahead.
Okay. So what you're talking about is it's artificially being changed. In other words, this $183 a day every man, woman, and child in America is paying. That's this QE4, or what Powell called not QE.
That's right. So all is well thanks to the benevolent, powerful steering committee at the FOMC, the Federal Open Markets Committee. And so we have established the price of peace. We have established the price of calm at this moment. And it's $60 billion a month, roughly $2 billion a day. And again, if that seems like an expensive habit, or, what it would take to kind of maintain a perpetual buzz, you just look at that national addiction, divide by every man, woman, and child. And as you said, it's a measly $183 a day, wow. Which at some point, if we're not careful, is merely going to be the cost of a cup of coffee.
Well, and I wonder if the Fed has ever been this powerful in history. And I know a few days ago, Trump invited Powell into the Oval Office. It was a completely unexpected meeting, but I know that Trump tweeted afterwards that he was quite pleased with how it turned out.
Fascinating. I mean, you always have the two sides of the story. On the one hand, Trump says, very good, cordial meeting, discussed including interest rates, negative rates, low inflation, easing dollar strength, its effect on manufacturing, trade, etc. And Powell walks out, and one of his first comments is, we're going to operate according to our legal mandates.
Right. When I saw that, Dave, I thought, okay, now wait a second. With him saying we're going to operate with our legal mandates, that already means that he's nervous, okay? That he's being probably manipulated to do things that he doesn't feel comfortable doing.
Pressured.
Oh, a little bit.
Yeah. And I mean, if Trump turns on the heat through his tweets and through the public channels, what does he do behind closed doors and sort of the private channels? This is where I think a good question has been asked. This is an unscheduled meeting between Trump, Mnuchin, and Powell. Right. And, it's an unscheduled meeting on the economy. I'm not trying to be, conspiracy theory oriented, but, there are rumors that there's a big bank that is having problems. And ordinarily, you don't get that group of people together to just sort of remind everybody of what their marching orders and what their duty is. Again, I maybe that's what happened. I wasn't there. I don't know. But we do have, Trump saying, hey, good meeting. I communicated my message. And Powell saying, I heard the message. And, almost a little bit of a pushback. I'll operate according to the legal mandates, which, what does that mean? Price stability and full employment are the two legal mandates.
Okay. But what was said at the Economics Club in New York? I think Trump was saying, give me some of that money, wasn't he?
Yeah.
Give me a little bit of that money.
Exactly.
What he's talking about is what the Europeans have been pumping in.
And I think the Fed is signaling something else because in their view, it's far more costly to not be involved in the markets at this point. And what other costs were conveyed to Jerome Powell in the Oval Office earlier this week? Last week, Tuesday, the president was slinging mud at the Fed for not introducing negative rates. We mentioned it in the commentary last week. It went, and again, that was the Economics Club of New York speech. Give me some of that money.
Right.
Give me some of that money, as our very eloquent president would say. Why don't we have negative rates in the U.S. just like the Europeans do? And of course, his contention is that stocks would be 25% higher than current levels if he got what he wanted, if there was even more benevolence from the Economic Steering Committee, that is the Federal Open Markets Committee, the FOMC at the Fed.
You talked about something going on in the background. We've talked before, could it be Deutsche Bank that is the black hole that's sucking liquidity? All crisis is, every time, is a lack of liquidity, right? That's what financial crisis always is. So what do? You just create out of thin air the liquidity. But what bothers me, Dave, is we're not talking about side joint kinds of countries. We're talking about the two most powerful countries in the world. The United States and China right now are scrambling to provide enough liquidity.
Yeah, and there wasn't a huge move by the Chinese this week, but they did cut short-term funding rates for the first time since 2015, 5 basis points, not a very big deal. But they're also involved in their own repo and reverse repo market. And I just think it's fascinating that you've got the two largest contributors to global GDP, the U.S. and China. They're both actively influencing the credit markets, and they want to facilitate calm. And, if you move beyond the treasury purchases, which, you remember we had Charles Goodhart on the program a couple of years ago.
Right, he was a central banker.
Very dismissive about the expansion of a balance sheet at a central bank, saying that you can sterilize those things. Sterilize, whatever that means. And, actually sterilization was a theme that was talked about and developed late 70s, early 80s. And I don't think anything was sterilized to the degree that you didn't end up with inflation eventually. But again, this idea that we're just going to do this stuff and there's going to be no future market implications.
Well, in the past, the Federal Reserve has talked about intervention where they come in where they need to, fill in the gap a little bit. It seems to me like they're taking over everything, that the keys to the farm have been handed over.
Well, as Karen Petru pointed out in the Financial Times, this was about 10 days ago, fascinating article. The Fed is on track to commit $11.5 trillion
with a T
in gross cumulative support. Now that's gross cumulative support to the repo market through the end of January. And as she points out, the Fed did not stabilize the repo market. Now it is the repo market.
The keys to the kingdom.
Yeah. So Karen describes it as de facto nationalization. And here's the point. As far as the Fed is concerned, no matter, just move along. Because the last thing the Fed wants is for investors to stop, for investors to gaze, for investors to observe or to judge the signs of the times. And think of it as like a traffic accident. The Fed's trying to prevent rubbernecking. You know what I'm talking about? That tendency to kind of slow down and stare. You're not implicated in the accident, but you got to see what happened. Is anybody hurt? What's going on, right?
But they're saying, move along, citizen. Nothing to see here.
That's right. Fly down the road at 70 miles an hour. Ignore what just happened. So, whether it's $60 billion a month in QE, which is not QE,
right,
or that $11.5 trillion de facto nationalization of a part of the lending markets, we're coming up to what I would describe as the price for oblivion. Right.
So oblivion or oblivious? Oblivion,
well,
oblivious?
Oblivion is defined as the state of being unaware or unconscious of what's happening. And that is precisely the state which is being funded by the Fed. What is the price of oblivion? $183 per person per day.
Wow. And that's the $60 billion plus the repo interventions that you're talking about right now. Or is that just the $60 billion?
That's just the $60 billion.
Oh my gosh, you're kidding me.
Yeah, no, I mean,
so just the $60 billion a month, I'm paying $183 billion. And the reason I say I'm paying it, Dave, is you don't print money out of thin air without the cost of losing value of that money down the road. There's no such thing as just doing that.
Well, that's why I say, at some point in the future, what are we talking about? It's merely going to be the cost of a cup of coffee, $183.
It's as if these Fed chairmen are drunken bankers. You know what I'm saying? It's as if it's a drunken party and they're just basically saying, hey, the punch bowl. Remember they used to call it the punch bowl. Wasn't the punch bowl terminology, didn't that come from the mid-50s by the Fed chairman at that time?
Well, exactly, because it wasn't like you're supposed to support the party. William McChesney Martin suggested you were supposed to take away the punch bowl before the party got started.
Right.
So you weren't supposed to let things get out of hand. Now it's, you can't let the buzz go away. We've talked about that before. But again, we're not talking the Fed here alone. This is the Bank of Japan, the European Central Bank, the Bank of England, the People's Bank of China. And this is precisely the state being funded by the Fed. It's oblivion. They want a state of being unaware or being unconscious of what is happening, right? So Jim Grant describes the Fed's behavior, particularly as it relates to the repo market. He said it's a little bit like a bank president who drives his Cadillac into the country club swimming pool. Right. He says the repo market is showing a whole new personality.
Wow. Well, and you wonder, I mean, let's face it, the stock market's hitting all-time highs. It must be working, right? If a person doesn't dig any deeper, it's a little bit like going on vacation with a broke person who has a credit card. Right. You think you're paying for stuff. You're really not. You're borrowing.
Yeah, it's fascinating to see a resurgence in popularity in the financial community. You go back to 2008, 2009, and there was this resurgence of popularity with an economist that most investors have never heard of, Hyman Minsky. Mm-hmm. And
the Minsky moment.
Right. So, in the search for clarity and the search for understanding for what had just occurred, people dusted off the Minsky instability thesis, which simply states a paradox, that stability begets instability. Huh. And I think it was Mohammed Al-Arian at the time, working alongside Bill Gross at PIMCO, who first described it as a Minsky moment back in 2008. Now, actually, it was not. It was the CEO at PIMCO, was Paul McCulley. He had kind of a knack for phrasing things. So the Minsky moment, Paul McCulley, that's what it was called. So traders, frankly, don't often get lost in the weeds in economic theory.
Well, they're busy with the day or the moment, actually. They're just trading on the moment. They're not looking at long-term economics any more than an algorithm would.
When your success or failure is mark to market on a second-by-second, day-by-day basis, and at the end of the day, you look at your P&L to see, the nature of the daily and the short-term trading trends and how it treated you, that tends to ingrain a certain pragmatism that's, can be devoid of philosophical or theoretical reflection. So when you think of theory, and like Minsky's theory, it's unusual to see that operative in people's mindsets. It's usually a discussion during a market postmortem.
Well, the postmortem, okay, after doing this for 32 years and seeing three major crashes, 87, 2000, 2008, they call them black swans, and people in the postmortem analysis, they're like, well, we really didn't see it coming.
Right. So you get into trouble, the search for a coherent explanation. In some instances, it's just a search for an excuse.
Right.
That begins in earnest, but it's kind of after the fact. So the most reflective moments for most traders are those moments where a portfolio has just been gutted.
I read a great autobiography years ago by Chuck Yeager, and he was part of the investigation when the Challenger blew up. But of course, Chuck Yeager was a pilot from the World War II. He was a P-51 pilot in World War II. And then, of course, he went on to break the sound barrier. I believe it was in 1947 with the X-1. But he was a man who could take that plane apart and put it back together. Every plane he flew, he could take apart and put back together. And one of the things that he said when he was part of the Challenger incident team, he said, we've reached a point where you have 1 million working parts and you have specialists in each of the areas of the shuttle. And so the danger is at this point, these men who are flying this particular machine, it's so sophisticated. And you talked about stability. It's so incredibly stable almost all of the time that it's almost impossible for them to realize that a frozen O-ring or something simple like that would be a reason not to fly.
Well, and I guess that's the point of the Minsky instability thesis, is that it is stability, which kind of tends to lead us to lower our guard. So we have stability. We have a normalized yield curve, no concerns about recession on the horizon according to that. And we have the VIX, the measure of puts and calls, the volatility index, which indicates a level of concern in the market or lack thereof. And today it's now in sort of the low double digits, 12 and change.
So snoozing. It's snoozing.
Yeah. And single digits are like the bell ringer on the VIX. Total complacency, disproportionate bullishness, high spirits. It's a bell ringer in the sense that, like clockwork, you get to a single digit VIX. Don't always have to go that low, but you get to single digit VIX, and that precedes every major period of volatility. Again, it's stability begets instability. The long average for the VIX is touch over 19. So it's sitting at 12 today. But again, like any freewheeling price, averages are made up of the extremes, highs and lows. And so from a single digit level, you're basically marking the extreme low. You frequently from that level see the VIX triple, occasionally even quadruple or quintuple.
You know, stability in all of life causes us to sometimes doze off. I know, sometimes when I'm driving, I'll appear somewhere, Dave, and not remember the drive because my mind was elsewhere. Now, I'm certainly hoping that I was driving safely the whole time. I think I probably was, but it's because it was an uneventful drive. Now, that's fine if I'm actually still observing and maybe, reacting to that because I've done that for so long. But what if somebody actually was creating a stability in a time that maybe I was in crisis? Let's say that they, instead of me thinking that I'm going 65 miles an hour, I'm actually going 120 miles an hour, but somebody, namely the Fed, because of interventions, negative interest rates, pumping of money, $183 a day, they've reached over from behind and they've turned my speedometer down to 65 miles an hour. Now, the danger at 65 versus 120 miles an hour is quite different, but what if I'm unaware?
Yeah. And I mean, I experienced a different version of that this weekend. I headed out to St. George, Utah and Zion National Park to do some training. And, you're cruising down the freeway at 70 miles an hour or maybe 80.
Oh, don't say that on the air.
I never speed. I'm not impatient.
It was just you and the dog, right?
That's right.
Yeah.
And so, you have this reminder of being on course. And then, of course, they've got rumble strips on either side of you. So if you start veering off course at all, you hear this brr, 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 and it's a wake up call that you're not actually going straight. And so the reminder is important. And I think one of the things that we look at in the credit bubble bulletin, we explore the why. We explore the why this is the case.
This is what Doug Nolan's been doing for decades.
That's right. So the credit bubble bulletin each week, why it is the case that stability begets instability. And he looks at how credit trends and how the looseness of credit, which appears as stability and encourages greater risk taking, at the same time is encouraging a less thoughtful allocation of capital. Mm-hmm. And in the end, you get to a point where the allocation is reckless. A reckless allocation of capital, all based on the assumption of financial conditions remaining the same, very supportive, and, what looks to be stable. So you end up with a misallocation of capital and sort of a seemingly inevitable last series of steps towards instability, which occur without there being really any negative effect. Because again, if you allow there to be enough liquidity in the markets, it's like taking away the rumble strips. You really don't know how close you are to the edge of the road. And if you hit the edge of the road going at a high speed, you can end up in a real bit of trouble. That's why the rumble strips are there. Liquidity kind of takes away that signaling in the marketplace. So prices jump higher and higher. Momentum takes on a life of its own.
Well, look at the stock market. All-time highs. All-time highs. Every day. Boom, boom, boom.
Short positions have to be closed out. That is a new form of buying in the marketplace. And the characteristics there for us, and again, Doug's giving you the why. Stability begets instability. But you look to the internals of the market and you can begin to see some unhealthy characteristics. So the late cycle boom in asset prices, they're accompanied with divergences. And those divergences are key to clue into. These are the indicators that suggest that something is not quite right. Something is off. Just an example, progressively lower volume. So there's less people participating in the stock market, even as prices are hitting higher and higher levels. Well, and that is a sort of divergence.
You said boom. Okay. That's 4-letter B word, right? Well, there's another 4-letter B word that you can almost always fill in after boom, right? It's bust.
Right.
And
right.
so boom to bust cycles. But when you look at that, okay, you talked about volatility, Dave. When volatility is low, which means people are not nervous, the VIX, right? The volatility index, that almost always means that stocks are going to go higher.
Well, so back to VIX. I mean, if you tie it, it's almost counterintuitive, this point. But when you have lower VIX quotes, that's married to higher stock prices. Mm-hmm. And the fact that they move opposite each other is helpful because we don't know. We don't know how high asset prices can go. The Nikkei reached 40,000 before it went screaming lower to 7,000, right? So, but in its ascent to 40,000, no one thought that it was possible to exceed 20 or 30. And then by the time you get to 40, everyone starts thinking 50, 60, and 70 is reasonable. But we don't know how high asset prices can go. But we do know how low the VIX can go. So the closer you get to zero on the VIX, the closer you are to, let's call it, Turkey Day.
Okay, so we were talking about postmortem because someday we will have a postmortem. When this market crashes, whenever it happens, we'll be sitting around and going, okay, well, we saw it coming, but here are the reasons for the trigger. Now, to be fair, I talked about Black Swan. A guy named Nassim Taleb wrote Black Swan, and actually, it could have been called Black Turkey because one of the examples he uses is coming up. I mean, Thanksgiving's coming up, and he uses this as an example.
That's right. So he writes that the happiest day in a turkey's life is the day he's being stuffed and fed. And it's preparatory to an event that he's mindless of, he's clueless about. It's the next day. It's the slaughter. So too with the markets, because our happiest days are the days of capital gains. And far out on the horizon, there is the reality getting closer to that sort of Minsky moment day, right? But the bird gets stuffed, the bird gets cooked. And I think when you look at the market today, we have a lot of turkeys running around, a lot of turkeys on Wall Street. What do they feed a good turkey?
Yeah, but okay, so I'm using my Apple iPhone. I'm using my Apple iPad. I'm probably going to have to get a new Apple iPhone about the time that they tell me I have to have my new Apple iPhone. If we can look forward and say, well, what a good company. Why would we even worry and not just buy what looks like it's going to be a good idea?
Okay, so try this on for size. What do these numbers all share in common? 62. Let's see if you have any sort of numerology background. 62, 45. This is not bingo, but just play with me.
Okay.
What do these numbers share in common? 62, 45, 32, and 40.
Is it the meaning of 42 is the meaning of the universe. We just don't know the question, right? That's Hitchhiker's Guide. So 62, give me those numbers again.
62, 45,
32,
and 40.
Okay. Well, what, I don't know.
Those are the amounts that Apple shares declined in percentage terms following a vertical ascent. Right. And we have a vertical ascent with Apple shares right now. Huh. Carl Swenlin's a technical analyst. He's been doing it for decades 4, 5, 6 decades. And he didn't start as a toddler. And he suggested that we're months away, not years away. We're months away from sort of that vertical blow off in Apple shares coming to a halt, and then begins the shedding of tears, right? So the average decline for Apple shares is basically 45% following a major blow off like we have now. Again, 62% negative, 45% negative, 32, 40. These are big numbers, folks. And this is an example of a stock which everyone owns, which is why I would suggest that Apple is exactly what the turkeys are being fed. And it's an example of a stock that everyone owns, whether it's hedge funds or mutual funds or ETFs or even Warren Buffett. That's a lot of fat and happy birds. I mean, everybody owns it. And Would it be a shock to you to see a 45% decline in Apple shares? Not to me. And would that be alongside a general market decline? Not necessarily, because Apple can enter its own sort of maelstromic vortex on its own. It doesn't need to get pulled down by the market, but it can hardly avoid a wider vortex in which it is one of the most heavily owned and broadly distributed shares of all time. Currently at a $1.2 trillion market cap, every bird is stuffed with this.
Okay, but could that possibly be why Trump invited Powell to the Oval Office a couple of days ago? Could it be that if indeed we're going to see the end of some of these rises, these meteoric rises, you don't want to have it happen before the election if you're Trump?
Well, and I don't know that, at least in terms of Swenlin's view, this is months away, not years. And does that month stretch out to 9, 10, 11 months? Does it get us to the election?
Okay, but that's Apple. Well, that's Apple. You had mentioned Berkshire Hathaway. We're talking about the greatest investor from Nebraska of all time.
Warren Buffett's taken a big bite out of Apple. And would it shock you to see a slide in Berkshire Hathaway shares alongside a general market decline? We said 62, 45, 32, 40. Berkshire Hathaway, arguably one of the best investors in the world, arguably. And we could get into that. But what are these numbers, 49 and 54?
I think you've already telegraphed that. Of course. Right? That's how much they've fallen.
Yeah, that's how much Berkshire shares fall in line with a market correction. So there's nowhere to hide when the market slides. Selling's indiscriminate. Doesn't matter if you're Berkshire Hathaway or a small cap company. What's the solution? You hedge accordingly, whether it's tactical short or like what we've offered in the marketplace or the physical metals exposure. Let me tell you a sad truth. Turkeys don't hedge.
Right.
Turkeys don't hedge.
Well,
they feed.
Pressure.
They feast.
Yeah, but there's pressure, Dave. I was talking to a broker. This is a guy who's been a professional for many, many years. And I just asked him, how does he feel about the stock market at these levels? He knows good and well that the price earnings ratio is over 30 because we talked about it.
At least the cyclically adjusted price earnings ratio.
Right. Yeah. The Schiller cyclically adjusted. And so being over 30, he understands that it always comes back down and usually comes back down to 14 or less. So that's more than half on the stock market if it were to fall. And I just said, what's your feeling? And he sort of laughed and he said, Trump's going to win the election. The economy's doing just fine. And granted, the Fed's got their back. There was this level of confidence that Dave, it bothered me because this is a man in his 70s. He's been through a number of crashes, and I think he's going to go through another.
Yeah. Well, I mean, this is the beauty of Wall Street and most investors. Right. The two constant themes are the shortness of memory and the short and quick return of greed.
We could have never seen it coming. Right. That's what they say. That we never saw it coming.
So when we talk about turkeys not hedging, where you generally see a popular transition, whether it's to an investor buying a short product, like tactical short. We call it tactical because it's flexibly or tactically reducing a short exposure. If the market's moving higher and against us, we eliminate the risk and get out of the way to a degree. So, or towards gold, something like that. Frankly, people only move there after the bloodletting has already begun or is largely done. And it's like, Chicken Little. Chicken Little doesn't get along well in the turkey pen. The turkey is a big bird and a chicken, according to a turkey, is barely a bird, right? And I might be getting carried away with the analogy here, but I think you get the point. Defense is an afterthought.
Right.
Defense is an afterthought. Preparation requires too much of us as individuals, investors, to think of it as voluntary cognitive dissonance, where you live in a normal world, you make normal decisions, you dream normal dreams, but you have a plan B.
Okay, but that's where the pressure comes in, because this is a broker who right now has to satisfy his clients. And his clients are watching all their friends making money in a stock market that's hitting all-time highs.
That's right. So any money that you take out of that, either to divert towards metals or short position or just sitting in cash, which is that's fine too.
You might lose your clients or your job.
Well, you have to be creating a certain amount of income. And if you're taking money off the table, then it's no longer a productive asset. You ask Warren Buffett, he'd say gold is an absurdity. He'd never own it, blah, blah, blah. And, he only things with cash flow. Well, investors have the same rigorous expectation. And you're right. There's investment managers who refuse to take anything off the table because they fear that existential threat of you're fired.
So using the stuffed turkey analogy, they don't have a plan B.
Turkeys don't take time for plan B. They don't take time for plan B. If there's a humorous movie, if you want to watch it with your kids or grandkids, this was like they did a series of these Wallace and Gromit movies. I think this was released 20 odd years ago. Clay animation series, or movie rather, called Chicken Run. Oh. and so if you can imagine blending Steve McQueen and The Great Escape, right? You got that picture in mind. Steve McQueen and The Great Escape, blend that with a clay animated contrarian chicken who is dead set on avoiding being turned into a pie. That's the movie to watch. It's a fun movie. And I frankly, I think the guy in the story who's turning the poultry into the pies, he looks a lot like Hank Paulson.
Oh, no. And that couldn't have been planned, right?
No. Because Paulson came a little bit later. He was Treasury Secretary in 2008. I think he was with Goldman Sachs in 2000.
Okay. But going back to what we were talking about, if I'm paying at $183 a day, or paying may be the wrong word, if I'm borrowing $183 a day to keep this economy going, is it really, okay, we're talking about stuffing the turkey. That stuffing's coming from borrowed money. I mean, how much money is being borrowed to make this thing look the way it looks?
Yeah. And I mean, we're criticizing one $60 billion initiative, monthly initiative. But the feeding of the big birds, you could go to, Reuters article this last week. Bank of America, Merrill Lynch calculated that since the collapse of Lehman Brothers, governments have borrowed $30 trillion.
30 trillion.
30 trillion. Governments of the world, since the collapse of Lehman, governments have borrowed 30 trillion. Companies have borrowed $25 trillion.
This is in the last 11 years.
Households have borrowed $9 trillion, and banks have borrowed $2 trillion since the collapse of Lehman. So by year end, global debt will top $255 trillion. That's 3 times global economic output. And here's a complicating factor, because when we had a debt crisis going back to 2008 and 2009, when we had too much debt and too much creative finance, and the numbers were a lot smaller than they are today, we did have a concentration of that in the financial sector and within specific financial products, mortgage-backed security related, right? The new complicating factor in terms of bailouts and in terms of political bargains is that according to the Bank of International Settlements and the International Monetary Fund, you look at this $255 trillion in debt, $190 trillion of that is outside the financial sector. You say, well, that's better for the financial sector. Yeah, but it's worse for having the ability to actually get in and do something about it. At least with the mortgage debacle, you knew where to find the problems and you knew which entities to bail out because you could connect the dots and know where the exposures were. This time, it's a little bit like a cancerous root system. It's buried in every crack and crevice throughout the global economy.
Okay, but trying to time this thing's almost impossible because the debt has been working. Let's face it. So far, worldwide, we've been able to borrow just about as much as we want without much consequence. It's been 11 years since the last crisis. Why in the world would we have another?
Powell last week, his comments, one of the truer things that he commented on is that our debt situation is unsustainable. Huh. He said at some point, the interest component on our debt is going to be too much. It's going to require too much of tax revenues. A truer thing has never been spoken by Jerome Powell. But speaking of Treasury secretaries, and not this time of the guy who looks like the clay animated
chicken
poultry farmer in
poultry farmer
in Chicken Run. Hank Paulson. Steve Mnuchin, I just want to do kind of a 12-month retrospective. Maybe it's 9 to 12 months, because here in this period of time, starting January of 2019, the vertical ascent in stocks has matched promises to pay and credit provided to the markets in an uncanny way. The vertical ascent in stocks and the new highs that we see day after day, they are predicated on access to credit. That remains the case today. It's financial conditions which are loose, very, very loose.
What a difference a year makes. Do you remember last year at this time? They had talked about maybe tightening up a little bit.
They were in the process of tightening.
Yeah, and things were going terrible for the stock market.
Exactly. And you had 2 days before Christmas, again, going back to Mnuchin, 2 days before Christmas. And last year, folks, this is not an eternity ago, but last year, 2018, Mnuchin was on the phone 2 days before Christmas to the 6 largest banks, assuring them that they had access to ample credit. You might well recall that Q4 period, the 2018 Q4, fourth quarter, was a disaster in the stock market. So, it's the ease of credit which has propelled stocks to all-time highs. It's not earnings reaching the stratosphere, which is dragging stocks higher.
Have you ever heard of the love languages? There are people who say, well, my love language is this, that, or the other. But it looks to me like the love language of the Treasury and the Federal Reserve is liquidity.
Oh, absolutely.
Liquidity.
Yeah, the Mnuchin was talking to the street, and you're right. He picked up on the love language, the language of liquidity, and the promise of liquidity in any amounts needed, right? So earnings, third quarter this year, we were finishing up 2019, 92% of companies in the S&P have reported for the quarter. Zero Hedge reports that you've got a blended earnings decline for the index, the S&P 500, for the third quarter of negative 2.3%.
Okay, so they're not earning money. It's negative as a whole.
Earnings growth is declining, right? So meanwhile, you've got Q4, the next quarter, we're in it now. Earnings per share is now projected to be negative, as the S&P is now knee-deep in an earnings recession, right? So that's where we are. Earnings are already sending you a signal, which to us suggests that the markets are deeply addicted. They're deeply addicted to hopium.
Hopium.
Hopium, that's right.
That is fueled by the love language of liquidity.
Right, that's or other various credit injections. And I want to point something out from Grant's Interest Rate Observer, because he commented on this recently. You've got the U.S. PMI, the Purchasing Managers Index, and this is apropos for us in many ways, because we manage assets at McAlvany Wealth Management and actually have an interest in this particular niche. When the U.S. PMI falls below 48, as it did in September of this year, 47.8 was the reading. Morgan Stanley observes the S&P metals and mining sector has tended to outperform the S&P by an average of 12 percentage points in the following year if a recession materializes. So again, a declining PMI, and you've got the S&P metals and mining sector outperforming the S&P 500 by 12 percentage points in the following year if a recession materializes.
Well, then that's if we have a recession. But what if we don't have a recession?
Or Morgan Stanley points to the outperformance by 96 percentage points if it does not.
Wow. Okay, so either way, it's going up. Once that index falls, what was the index again?
The S&P 500.
Okay.
Yeah.
Okay.
And so the small component S&P metals and mining sector tends to outperform when the U.S. PMIs move negative, move below 48. So what are we saying here? Yes, I maintain the view that indiscriminate selling can hit even undeserving companies. Maybe Berkshire Hathaway is undeserving, but it can still decline 40, 50% in a market decline.
Sure.
Apple, again, 60, 30, 40, 50, an average of 45%. You've got companies that can sell off hard, but there are carve-outs nonetheless. And that is, there are areas that make more sense than others. So yes, a hedge makes sense. And yes, a contrarian mindset, which adjusts positioning to sectors less vulnerable, also tends to make sense.
So what you're saying is have some gold, and if you have stocks, and you have to have stocks, a lot of the people listening to this program have to maintain a stock portfolio, Dave, because they're professionals and they have certain requirements. You need to have a hedge if you have to own stocks during this period of time, and that could be the tactical short as well.
Right, and I'm never opposed to cash. I think cash makes a lot of sense, and having up to 20-25% of a portfolio as a minimum cash position today, I think does make sense. But here's the present tense reality. It's simple. The markets are on a tear higher. So we have, as we described earlier, we have a form of stability.
No matter what it costs.
And I just would remind you of Minsky at this particular moment in time.
Stability breeds instability.
I would remind you of Minsky so you don't have to blindly go to the financial slaughter when instability becomes a reality of the moment. And I think that moment is not far from now.
You've been listening to the McAlvany Weekly Commentary. I'm Kevin Orrick along with David McAlvany. You can find us at McAlvany.com, and that's McAlvany.com. And you can call us at 800-525-9556.
This has been the McAlvany Weekly Commentary. The views expressed should not be considered to be a solicitation or a recommendation for your investment portfolio. You should consult a professional financial advisor to assess your suitability for risk and investment. Join us again next week for a new edition of the McAlvany Weekly Commentary.